Peace and love, family. It's your brother Isaiah again with another video. Let's get to it. So this time I'm coming from the Child Tax Credit Act. You know, if you didn't know, well, now you know. They do have an act that's called the Child Tax Credit Act. And it talks about credits being allowed for a child that's connected to a taxpayer account. So let's just read a little bit of this. It says child tax credit. Allowance of credit there should be allowed as a credit against the tax imposed by this chapter for the taxable year with respects to each qualifying child of the taxpayer, an amount equal to $500 for 100 in the case of a taxable year beginning in 1998. And then it says B, limitations based on adjustment, gross income, and then 1, general. The amount of the credits allowable under subsection A shall be reduced, but not below zero, by $50 for each $1,000 or fraction thereof by which the taxpayer modified adjusted gross income exceeds the threshold amount. For purposes of preceding sentence, the term modified adjusted gross income means adjusted gross income increased by an amount excluded from the gross income under section 911, 931, or 933. I'm going to stop right there. So basically, this act is an act that talks about allowable credits to children or to the child that's on that taxpayer account. So me, you, and your mother, your brother, all of us, we are the child that's connected to the taxpayer account, which we are allowed a deduction of taxes because we're not the principal. We are the secondary obligated party. Whenever the principal is charged, we are allowed a deduction or a tax reduction so that we won't have to come out of our pocket. If you want to know more about stuff like this, you can catch me at thepeoplesremedyinc.org. Peace and love.